All right. Well, welcome everybody. We should be good to go. Give me a thumbs up or a one in the chat if you can hear me clearly. Welcome, guys. Welcome, welcome. Welcome, guys. Yeah, drop a one in the chat if you can hear me clearly. Welcome, everybody. Looks like we're going. Perfect. And drop a two if you can see my screen clearly. All right, nice, nice. Thank you, guys. Thank you for the feedback. And so sorry about the switcheroo at the last minute. We're having some problems with Zoom recently, but we'll get it figured out. But hopefully you guys were able to join here. And if anybody has to step away, this will be recorded, and I'll send out the recording probably very shortly. Perfect. All right, so we'll give it a few minutes to make sure people have time to join. I know there's a last minute switch here, but hopefully you guys are all doing well. Let me know, like I saw a few people mention it, where you're tuning in from. Always cool to see. I see Arizona here, John, Colombia. Hey, Ali, how's it going? Germany. Looks like it's midnight there. That's dedication. Again, this will be recorded, so if you have to step away, no problem at all. Hey, Jay, good to see you guys. Texas, Maryland, nice. Florida, Dallas, Florida, very nice, guys. Hey, Jordan, good to see you. Lloyd, Hawaii, very nice. Belgium, Florida, Ohio, very cool. All right, awesome, guys. Awesome, awesome. All right. Okay, well, we'll give it just one more minute to make sure people have time to join. Again, sorry about the quick switcheroo if you're just joining here. We're experiencing a little bit of difficulties with Zoom recently, and I had to make a game time decision and switch it to YouTube, but this will work well. All right. And let me make sure I'm recording. Perfect, I am. Awesome. All right. So I think we'll give it just 30 more seconds here. And while we're waiting here, drop in the chat what questions you have about trading gappers. What's kind of your biggest difficulty, trading this setup? If you do trade the setup, if you don't trade the setup, what would you most like to learn in today's session? We'll try to answer as many questions as we can today. Yeah, sorry about the switch again, guys. But looks like a bunch of you guys are here, so this is great. All right. Yeah, so let me know your biggest questions regarding trading gaps, earnings gaps. People call them power earnings gaps. EPs is kind of a subset of these, and we'll talk through all these ones. All right. Entry execution is challenging. Perfect. We'll talk about that. Guessing the correct entry point. Well, you don't have to guess. You just have to have a repeatable entry tactic, and we'll talk about a few that you can use today. When/where to enter and setting stops. Perfect, Jay. We'll talk about that. It would be helpful telling the difference between a gap and a stage 2 or 3 versus exhaustion gap at the end of a move prior to larger retracement in price. Yeah, we'll talk about a little bit about that, which gaps we prefer. Very shortly I can answer that. Early in a stage 2 uptrend or early after a market correction like we just experienced is probably the best time to be trading these gaps. All right. When do you know if you're wrong on an entry? Well, if it breaks a low of the day or your stop for sure, that's when you know you're wrong and you want to exit. All right. Cool. Joe asked, do you prefer to enter on day 2? I actually prefer to enter on day 3+ on like a range breakout after we've moved up, form some type of consolidation, set a range, and then break out from that. And I'll talk through kind of the pros and cons of day 1, day 2, and day 3+ entries. Yeah, and we'll talk through some process for finding these, scanning for them, all of that. So perfect. Let me just get a sip of water and we'll get right into it. All right, perfect. First things first, again, my sincere apologies for having to switch up from Zoom to YouTube at the last minute. We're having some difficulties there, and basically we had to make this switch. I had to make a game time decision, but it looks like a bunch of you guys found your way here, which is perfect. And if you're watching this recording, no problem at all. Again, if you're watching this live even, this will be recorded, and I'll send out the recording probably either later today even, or definitely by tomorrow to make sure you guys have time to review this. But welcome everybody to the next bonus webinar as a part of the Trader's Handbook educational series. Today we're focusing on the gapper setup. Previous webinar was focused on trading bases up the right hand side, base breakouts, and today is kind of the next subset of the main setups that we use at TraderLion and that I trade personally, of course, right now. And the gapper setups are incredibly powerful, and it's a great one to learn and master, but it's a little bit more complex and nuanced in terms of how to trade it, and a little bit scarier than trading standard base breakouts. So I think it's a setup that a lot of people are curious about, and hopefully we'll answer a lot of questions about when and how to enter, how to manage risk, and really basically how to trade these with confidence. So hopefully you guys will enjoy this, and let's go ahead and dive right in. So this is a nice quote to start things off from Christian Kouamagi. He's talking here about episodic pivots, which is a subset of earnings gaps, power earnings gaps, just gap ups in general. These are more based on catalysts. They're not necessarily based on a catalyst from earnings, but just in general, here's what he says. Earnings pivots, a setup I learned from Pradeep Bande of Stockbee, has rewarded me several tens of millions in profits over the past couple of years alone. That's a great testament to the power of this setup when used correctly. And, we'll dive into, the nuances today in this session. So here's the agenda today. First, from a high level, we'll talk about what the gapper setup is. Then we'll talk screening and finding day one gaps, day one entry tactics, screening for day two gaps, day two entry tactics, day three and beyond entry tactics, and a little bit on sell rules, and then run through some model book examples, as well as some recent examples of, gap ups in general recently to show how to apply the concepts we'll be talking about today. So let's go ahead and dive right in. So key goals of the webinar, discuss the gapper setup and how to trade it with confidence. Again, I think this is a little bit more of a scarier setup for folks because there's this big gap up and people think it's going to fill. But often, as you'll see, if you study this, the strong gap ups that act well are often just the beginning of major moves, or at least a major momentum move and a tradable opportunity before they ultimately roll over, pause, consolidate, set up a new base. And from that point on, whether it breaks down or continues higher, doesn't really matter because there was that tradable momentum move. We're also going to share a simple and repeatable process for identifying the best gapper setups on day 1, 2, and beyond. And like I said, discuss a lot of entry tactics regarding how to trade them day 1, 2, and 3 plus, and then finish things off with studying key examples of historic and recent gapper setups. So first things first, I just want to, discuss the setup as a whole. So really, this is an element of market structure. It's a byproduct of huge supply and demand imbalances caused by game-changing catalysts that happen overnight or after hours. The most common reason for a gap, big gap like this is earnings reports, and stocks blowing things out of the water, or on the flip side, gapping down because they miss expectations. Again, these earnings gaps, if for instance, a company reports game-changing earnings, has an earnings beat of over 100%. It completely changes how institutions have to value that company, and that changes their valuation models, their spreadsheets, and suddenly they might have to say, hey, we really have to increase our position in this based on the mandate of, what our goals are, and we have to start accumulating that stock. And that's what causes this big gap up. And not just that big gap up, but the continued buying accumulation that happens throughout a trend, because the largest institutions, are not, acting alone. Often if one institution has to increase their position, a whole bunch of other related types of hedge funds and, money managers also have to increase their position size. And so that causes kind of a fight for shares. And these institutions are trying to accumulate millions of shares, hundreds of thousands of shares, and they simply can't do that in just one trading session. And that's what creates, the trend that we see, as with every dip, more and more institutions are accumulating, building up, capturing any supply that comes to market. And that's what creates the trends that we can ride as retail traders. And this is actually a really good example. If you know the stock here, this is a very historic one. So put it in the chat if you know what stock this is. But this is a great example because there's a short-term momentum move right after earnings, and then there's a pause, another momentum move, and then kind of a longer duration move that happens after kind of this initial momentum move. So this is pretty, it's a great example because often, this is a tradable opportunity for very short-term day swing traders. Even this opportunity after some consolidation is often another opportunity for swing traders. And then for position traders, there's that longer momentum move that can occur, and even swing traders can get involved here. So nobody's gotten it just yet. So I'll give it, maybe a few more guesses, but I'll tell you what it is in just a minute. But just in general, this is a great example because there's a momentum move right off the bat that the day swing traders would be selling into strength, and then the rest of the market participants also can participate at these follow-on setups here. All right. Note, this actually is not NVIDIA. This is Tesla back in 2019. You could actually have used the dates down here as a clue. This was when they reported game-changing earnings. There was really a shift towards proving profitability and growth. And that's what led to this insane move in the end of 2019. And then we had the COVID correction, and then this set up for another 1,000% move. So this is a great example of how powerful a game-changing earnings report can be for the prospects of a company, and how it can start an extensive move in the market. So this is Tesla, and we'll dive a little bit deeper into this example later on. So what is the gapper setup? The gapper setup is based on a stock gapping up on large volume with a catalyst, aligning closely often with high volume edges. The high volume edges we discussed in the edges webinar, looking for the highest volume ever. That's the best edge, highest volume in 1 year, or the highest volume since the IPO week. And not, in order for a gapper setup to be valid, it doesn't need the high volume edges, but we are looking for game-changing volume, ideally close to those high volume edge levels, and definitely a significant price reaction and gap. The setup is most effective when it occurs early in a strong uptrend, as later gappers may signal momentum deterioration and institutional selling. They're more exhaustive gaps than kind of trading opportunities, and entry areas are identified after the gap using specific tactics and are considered most effective when a stock closes in the upper 50% of its daily range on day one. And we've got a nice example with ELF from 2022 to 2023. It really demonstrated the setup's power with 3 consecutive earnings gaps, leading to a 350% gain over its month-long trend. And EPS growth, acceleration, and multiple positive earnings surprises, plus 106%, 65%, 126%, played a key role in validating and strengthening the gapper move here with ELF. So that's a really good example of how it can lead not only to a nice flash in the pan momentum move, but also a duration move that, active investors and position traders can participate in. So trading a gapper playbook, we'll kind of revisit this, but this is from a high level, exactly what we're trying to do. First, we want to regularly scan and identify stocks gapping up on significant catalysts. And then when we investigate and identify a potential earnings gapper, we want to analyze and judge the game-changingness, I just invented that phrase, of the catalyst, and interpret the price and volume action and see if it's significant enough to, trigger this setup that we're trying to, jump on the ride for. Then after that, after we've found the ones that we want to focus on, we want to identify low risk entries on day 1, 2, or 3 plus. And I want to emphasize this is a momentum setup. Expect significant price moves. This isn't for the faint of heart people or people who want a more steady ride. This can be a big, lead to some big surges in price, but also a longer term duration move after price kind of settles down. And then after we've entered the stock, we want to manage the trade based on our sell rules. Again, if you're more of a day swing trader, you'll probably be selling more into strength in terms of when that immediate momentum comes. If you're more of a longer term position swing trader, you're maybe selling a little bit into strength, but then looking to hold for a longer move that could just be the beginning caused by that gap. So this is probably a very common question when it comes to trading these gappers, is what does the catalyst have to be in order to be significant? This is a list of a few types of catalysts. We've got earnings beats and raises, first quarter of profitability. That's a big one, especially for recent IPOs. This is a key one to look out for. The first quarter where they're profitable and really say in their earnings conference that this is kind of turning the corner and they expect strong growth after that. That can be a really big catalyst. You definitely want to look out for this. Significant new product news. We saw, of course, with AI and NVIDIA, a lot of gaps caused by product news that led to that, massive increase over the past few years. Partnership announcements. This is going to be a big one. Regulatory changes. This can also, completely change an industry. And then you want to look for the strongest gap ups in that industry. Index inclusions is a little bit of a weaker catalyst, but can lead to some nice moves as well. We just saw this with coin, and I believe I have that as an example later on. And then analyst upgrades and downgrades. This is not preferred. We don't necessarily want to trade this type of catalyst because it's more of a flash in the pan versus a game-changing development in the company. And I think I summarized it well here. The best catalyst represents a significant shift in the company's expected earnings and revenue growth and catches the market completely off guard. Upgrades and downgrades just kind of leads to, the stock being in play for one day. We don't want to be looking for a catalyst that will be changing the prospects of the company for the next week, for the next month, for the next few years. That's what we're looking for, and that's what institutions are looking for to really ramp up their accumulation of a potential stock. Then I just wanted to bring it back to this. Whenever we're interpreting any trade, we do want to bring it back to the Tigers framework. And this goes for catalyst gappers, earnings gappers as well. So we want to be looking for stocks that are part of a leading theme, are showing key innovation, standout product service. Maybe the reason for the gap is related to this innovative aspect of Tigers. We want to see significant growth, edges, relative strength, and setup. And of course, the setup for this one, as we're talking about today, is the gapper setup. All right, so let's get to screening for day one gapper setups. This is a setup in deep view, and this is something that you could probably replicate on other platforms if you'd like to. Basically, it's looking for significant gap ups based on action during the previous day or in pre-market. And I basically got a column here, pre-market percent change. I'm sorting by that, and sorting in this case just a general pre-market screen that's looking for at least some dollar volume, at least some price. So very low bars, low quality filters to just get rid of the penny stocks and those type of names. And then just sorting by price percent change in pre-market and looking at see what's up the most in pre-market. And those will be your gap ups to start that day. So this is how you look for it in pre-market. Then you look for the pre-market volume versus the average. You can see here, this was a screenshot taken on the day where all the quantum computing stocks had significant catalyst behind them. And those were the stocks in play for that day, the gappers in play for that day. And you can see that not only are they making big price moves, but also they've got really significant volume, over 10% in pre-market is what I consider significant in a pre-market as well. And that's what we're kind of looking for if you're looking for these in pre-market. However, I really would say that in order to really plan out a trade and be ready to go, pre-market probably isn't the preferred way. You'd probably want to be looking more in post-market, and we'll show how to do that in just a minute. It's a very similar process. But unless a stock is reporting earnings or has a catalyst in pre-market, probably you want to plan it a little bit more by doing more of your work the day before. And this is a very similar screen. I have a dashboard set up in deep view that shows me the biggest earnings gainers up here, or, just gappers in post-market here. So this is what you look for after the market closes. And here, the biggest losers. And then I can click these and show the chart and analyze the price action. And very similarly, we're looking first at the names that are gapping up the most in post-market. They have the greatest post-market percent change. But then also, and this is really key because, again, we want to be involved in a stock that institutions are starting to accumulate in post-market. We want to look for really significant volume in post-market compared to the average daily volume. And kind of the cutoff for me is I'm looking for, at least 20% the daily average volume, but ideally 30, 40, especially 50% or more. And this was an example of Okta quite a bit ago. It led to I think 20% gain over the next few days after this gap. But it had reported, really great numbers on earnings. It was up about 14% in post-market. And very critically, the post-market volume was over the daily average volume. That's huge. That's exactly what we're looking for. So set up something similar here where you can look for in post-market, what are the biggest movers and what is the volume compared to normal during the day, and that will really help you identify the ones you want to investigate further, dive in deeper into the earnings report, what's significant, what is the catalyst, and basically make that judgment for yourself, whether it's game changing enough to be potentially a gap and go the next day and to actually trade on day one. And I'll show you how to do this in DeepView and set up a dashboard like this near the end of today's presentation. But yeah, very simply, again, in pre-market, you'd be looking for pre-market percent, the biggest movers, and then post-market, you'd be looking for the post-market percent movers. And yeah, I'll zoom in on the table a little bit here. Basically, I've got, sorry, it's a little bit blurry. This is a screenshot. Basically, post-market percent change. And then this is the post-market volume versus the average 50-day volume. You can see here it's up 14%. And then volume compared to normal is 100%. So in post-market, it's already done the average daily volume. That's huge. That's really, really big. Again, we're looking for 20% or more, and really 50% or more is the best that you're looking for. All right, and then this is just showing a little bit about ELF, that example I mentioned. This is showing all the gaps that it had during this incredible move, and this is showing during one of them, the November 2 one, the earnings surprise numbers. And in DeepView, you can hover over any of these earnings reports and see a quick look at the reported values and how they compare to the expectations. And seeing a surprise number of over 100%, even over 50%, is significant. And that can lead to a really nice gap and go move and just longer term duration move if a company continues to keep doing this. So this is just showing an example of ELF and that power. All right. So this is that Tesla example that we talked about. We'll revisit this again at the end when I show a few of the more kind of historic numbers, but this is from the Trader's Handbook model book. This will be part of it in the back there, and basically is annotating this move and the key ones. It's a breakthrough in HVC here. We'll talk about the entry tactic later on. We've also got a range breakout here. That was another opportunity. And then later on, a more significant range breakout here that led to a parabolic move into the end of 2019. But just want to summarize here. Early in the stock's uptrend, even at the start of it, gap ups can be an excellent opportunity to build a position with strong momentum behind you. The catalyst behind the gap is also very important. The best news catalysts are completely game-changing for the company, a huge partnership announcement, a breakthrough in technology that will lead to big earnings and sales growth, or it can even be an incoming new stellar CEO, surprise profitability, or regulatory changes. We want the catalyst to completely change how institutions are valuing the stock, leading them to have to add or start positions, creating the trends that we can ride and participate in as traders. And here I get a little bit more detail on the Tesla gap. This Tesla gap started its model book move from 2019 through 2021, and the gap was on the highest volume in over a year. And then the next day, if we look here, it was on even higher volume. So a clear sign that institutions are starting to accumulate the stock. And Tesla had reported a surprise profit, and that execution and expansion of new factories and new vehicle models were ahead of schedule. And the key question up to this point was if Tesla could become consistently profitable and actually grow. And this earnings report was kind of a key turning point to answer this question. And it's kind of what institutions were waiting for to see and prove that they should start accumulating Tesla. So this earnings report was game changing, and again led to some tremendous trading opportunities, during this move and then also in 2020 as well. All right. Then a little bit more on the gapper setup. This is an example of Reddit from last year. And let me zoom in here to show this. This was the news related to this gap right here. Similar to Tesla, this was the first time it was profitable. Reddit reported a net income of $29.9 million, marking its first profitable quarter since its IPO. Analysts had anticipated a loss of 7 cents per share. So this is a significant surprise. And basically, there's also revenue outperformance and daily active user increase and beat of expectations. So very similarly to Tesla and how it started its major move, this led to a really nice move in Reddit. I was a part of this. I was in a little bit early, added here, and actually added on the range breakout right through this pivot. We'll go through that example later on. But basically, this is the type of report you want to see. And especially when it comes to recent IPOs that have been out for, at least since the lockup period, you're looking for that first time profitability, because that's really what a lot of institutions are waiting for to signify that, hey, we can go ahead and start accumulating this stock. It's actually proving itself. And often, as we've seen, there's a longer basing period with these recent IPOs, and often this gap off these lows and from that first base, that first consolidation, again, is the start of a more mature price trend and significant move that we can participate in as traders. So here is A-Lab. This is another recent example from last year of a recent IPO that went through a longer term basing period. And then it had a few catalysts. We had a new technology, a new generation of its technology. We also had an analyst profit target raise. Again, by itself, that's not necessarily a gap we want to participate in, but that was accompanied with the announcement of a new technology, again, the new generation of its technology hardware, which in of itself represents the potential for more earnings and more sales in the near future. Then it also had the earnings gap on huge volume again, and this led to a nice tradable move in the end of 2024. And again, we had an EPS surprise of about 31% here. Yes, it's not yet profitable, but it's showing growth and it's beating expectations, and that's what we're really looking for. Again, we're trying to interpret news catalysts that the institutions are seeing as game changing, and the institutions are interpreting as key signals that the stock will grow its earnings and sales significantly in the future. That's what we're looking for in terms of a catalyst. Here's another example. This is Palantir. This is the gap that really started its recent amazing move. It rose over 1,000% from this place, from this point right here. And this was a gap that occurred after it had based for quite some time, over a year, since it pulled back from its IPO move, and was in just a stage one. And we're looking for, again, the start of a stage two. And just similarly to Tesla and Reddit, this was the first quarter where it was gap profitable, and also it reemphasized at this point, development of its AI software, its platform, and its integration of large language models, which is what, again, institutions are looking for to signal that there's new products, new developments that will lead to increased profitability in the future. And this certainly was the case. And it had a nice initial move up higher, formed a nice range breakout setup day. And this would have been a really nice range breakout to buy. And then this increased, I think, 90% in just a few weeks. So again, shows the power of these type of moves here. This is Tesla, just to show, again, some different types of catalysts. We have an earnings gap here, but then we also actually had an election catalyst. And often, this isn't always the case. We saw a lot of gaps last year, but even more significant for Tesla, this one was because of how integrated, Tesla was becoming with Elon and his connections to the new incoming president. That's why this was significant here. And again, we're just looking to see significant catalysts that impact a company. And this one was viewed as positive and led to a nice tradable rally into the end of 2024. So in some cases, an election can even be a game-changing catalyst for a company. All right, so those are some examples of gaps and catalysts that can help kind of how you think about how to interpret things, and as catalysts come in, how to think about them if they're game changing enough. So now that we've talked about the catalyst aspect of it and how to consider whether a gap is worth trading, does it have enough post-market volume? Is it significant enough in terms of the catalyst behind it? Let's talk about actually the gapper setup and gapper entry tactics to use along with this setup. So day one, the entry tactics you want to use, and the day one I call is the day of the gap. So this is the first day where it's potentially a gap and go. You likely need to be prepared the night before / in pre-market and be focused on that stock to act, very early on in the session. And we'll talk about different entry tactics you can use: the opening range breakout, the anchored VWAP test / reclaim, and then also an intraday range breakout, a base breakout. Then even after day one, there's often a continuation buy point on day two, especially in the highest momentum names. And we'll talk about different entry tactics you can use there. You can use a lot of the similar ones here, but also the high volume close, test / breakout, and also an intraday range breakout once again. Then day three, after some pullback, maybe it's starting to pull back after the initial move higher. After some consolidation, you can use a daily range breakout or even a high volume close retest. And the high volume close, for anybody who's not familiar with it, let me go to an example here. The high volume close, let me bring up Tesla here. This is the day of the gap up. So this would be day 1 here. This is day 2. And then day 3 and beyond is, after the count of day 1, day 2. And then the close of the gap up day, which happens on large volume, that is the high volume close. And that's often an entry tactic for day 2 and even day 3 and beyond if we pull back to that level and respond positively to it. And we'll go into more detail, but just want to explain that quickly for anybody who's not familiar with the terminology of the HVC. All right. So day 1 entry tactics. And before we dive into the entry tactics here, I do want to preface this by saying we're going to be talking about some intraday buy points here on day 1, and intraday ways that you can enter and manage risk. Intraday techniques and buy points are not for everybody. If you're somebody who works full time and aren't able to watch a stock closely, right off the open, probably you're going to look more towards day 2 buy points or day 3 or later. And day 1 buy points do involve looking at intraday charts. And I do want to emphasize again that the only reason we're looking at intraday charts is because something is significant enough happening on that day that there could be a significant enough trend on that day, a significant enough move that we can manage risk and enter and have a cushion by the end of the day. The only reason we're looking at intraday charts is because the stock is set up on a daily and weekly time frame. And that's why we're looking at some intraday entry techniques. So let me get a sip of water here. All right. So this is a 3-minute chart of Okta. And the first entry tactic we'll be talking about is the opening range breakout. The opening range breakout, and let me see, actually I have a slide on the opening. I actually don't. The opening range breakout is when the stock initially, sets a range where it starts to move up or starts to move down and sets a clear pivot, a clear high in the first few minutes of a session. And then the opening range breakout is when we break above that intraday pivot level. And really, it's basically a mini base that forms right off the open of the stock. And often in the strongest names, the stock will break out of its opening range breakout and just trend upwards the rest of the day above its anchored VWAP. So this is often the earliest buy point. And here we've got an opening range breakout with Okta. You can manage risk at the low of the day under 3% risk. So your stop would be placed right under this bar's low here. And even if you want to be a little bit tighter, you might get shaken out a little bit more, but you could place it, under this bar or even the low of the breakout bar. But basically the buy point is as it pushes through that opening range high, and your stop loss is at a key level, often the low of the day. And with all of these intraday techniques, you do want to manage risk pretty tightly. And the reason being is that, these type of moves, these gapper moves can be pretty volatile and can shake and bake quite a bit during the first few minutes of a session. So you want to be sized and managing risk tight enough that, you could take a few losses and still feel confident enough to try it again, because you only need one entry that really works and trends to really recognize the power and potential of these day 1 moves. Here's another example with Tesla. I think this is at the election. We have an aggressive kind of 5-minute opening range breakout. This is the key high. It pushes through that. This would be an entry, manage risk at the low of the day. But we also set up another opening range right here in the first few minutes of the session. And this would be another valid entry point, managing risk right here under this higher low. And it basically trends nicely the rest of the day. This is exactly what we want to see when we buy these opening range breakouts. And then this is also the anchor VWAP reclaim. We'll talk about that entry tactic pretty shortly as well. Here's another example of an opening range breakout. The stock pushes up higher here in the first few minutes of the session, sets this high. This becomes the key pivot. And then this would be the opening range breakout. And you would want to manage risk at the higher low right here, which is about 3.5%. So pretty tight here as well. This would also be an early entry within the opening range. You can see this is kind of a range breakout that we talk about on a daily chart. But here, in this case, we're looking at an intraday chart, and you manage your risk really tightly right here. If you get shaken out, you're fine because you've taken a small loss, but you can enter a little bit earlier and manage your risk a little bit tighter than this opening range breakout here. But basically, the opening range breakout is when we get an initial move higher, or just a clear line of resistance gets set in the first few minutes of a session, and then we consolidate and then break out through that clear line of resistance. And then you want to manage risk likely at the low of the day, or at a higher low under 4%. That's the goal here. Here's another example of the SMCI, really powerful move back in, I think, early 2023. We have a clear line of resistance here that gets formed. It consolidates for one tight bar. And then we have a 1 minute opening range breakout. There's a very fast one. Risk to the low of the day was only 3%. And then this trended beautifully and made significant profit for you, many risk multiples by the end of the day. So, I see some questions about time frame. The more aggressive traders can use 1 or 3 minute time frames, but I think 5 minute is kind of the ideal here. You don't want to get shaken out too much by the noise that can happen very early on in the session. But I think with all of these entry tactics, all these setups, you have to study it for yourself and see if you're more comfortable trading, the 1 3 minute or the 5 minute. I personally look at a 1 minute chart when the stock first opens, and then very quickly I'm switching to a 3 and then 5 minute as the day progresses and we get more information, more bars, because I don't want to mess around really with the noise on the 1 minute charts. So I want to get off of those as quickly as possible. And especially if you're stage 2 traders, I think sticking with the higher time frames, 5 minute, just from the very get-go, should be, the default. More advanced traders, stage 3, stage 4, can look at lower time frames if they'd like to. But even for them, I think looking at a 5 minute chart as your lowest time frame is probably the way to go. Here's another example with ASTS. This was based on a catalyst where they had partnership news with, I think, Verizon. You had an initial move higher. It sets a resistance level right here. This is the opening range right here. It sets up a lower entry right here. Managing risk at the higher low, about 5%. This is a really fast mover, so that's why the number is a little bit higher. So you'd have to size this lower because this has the potential to move significantly. And you get the openings range breakout here, setting your stop at the higher low right here. Again, about 5%. And this made a really nice move into the end of the session. The reason we're looking at 1, 3, and 5 minute charts is because we're looking at intraday timeframes to judge when that opening range is set and when that key line of resistance initially, takes place. So that's why we're looking at these intraday charts. 1 3 minute, is just to get that added resolution and identify resistance and support levels early on in the session. Then, after the opening range breakout, the next opportunity is often at a little bit more of a mature intraday base. We often get an initial move off the open in the first half hour, 45 minutes, and then we kind of consolidate and form an intraday base. And often up the right-hand side of the base, either if it's at early pivots or at the base breakout on an intraday time frame, there's often a spot where, again, you can manage risk and by the end of the day, build enough cushion to hold through until the next day, setting your stop at the higher low. So here's an example. This is TEM Catalyst Gap. I think the catalyst here was maybe a new product announcement, or it might have actually been Nancy Pelosi adding it to her portfolio. That's a valid valid catalyst because the market cares about that. And here we set up a really nice base after this initial move higher. And there is an opportunity right here to add at kind of a low cheat. But even if you wait until the base breakout, the intraday base breakout, you have a really nice profit going into the end of the day. So a really good example of initial move higher, which would be really fast. Then it consolidates, absorbs any supply coming to the market, and you're looking to analyze the base just as you would on a daily chart and look for those clear pivots, clear buy points, managing your risk at a higher low, or waiting for the clear breakout and buying through that level. Here's another example with ELF. This had a really powerful initial move up, but then it based and tightened. And then this would be initial buy point and setting your stop at the higher low right here. And you have a nice profit by the end of the day. You have about 3R, and 1R is basically your risk multiple. Your initial risk would be about 1%, setting your stop at the higher low. And at the close, you have about a 3% profit cushion, enough to hold through the close and try to gain a more meaningful trade by carrying it over to the next session. Here's a good example with BE where we had a large pull-in at the start and we have an intraday base that forms back in this area. You can see the tight action on low volume, and then this would be your early buy point from that intraday base and getting a nice profit cushion by the end of the day. Risks to the higher low right here would be about 2.75%. So you can see that we're trying to find low risk spots just as we would analyze and find them on a daily chart, but we're acting a little bit faster on the intraday timeframes. And, again, we're talking about intraday timeframes and charts here, but, if you're not somebody who trades that situation well, I just want to remind you that you can 100% be very successful trading gapper setups, waiting for day 2 and not even getting involved on day 1. And why that might even be better is because if you wait until day 2, you already have the added information of seeing that the stock acted well on day 1 and seeing that additional signs of strong accumulation, HV1, HVIPO, strong closing range, all of that, and waiting for either a post gap range, or a day 2 entry, and getting kind of to see the cards on the table versus trying to get involved on short-term time frames. So if you're newer at this, you might want to just, instead of trying to trade day 1, just start with day 2 or even day 3 and beyond, and focus on those setups, those entry tactics, and gain some familiarity with the setup before you try to get involved on day 1, because you definitely want to manage risk tightly and don't want to get involved on every stock on day 1 here. Here's a bonus setup that I prefer. Actually, this is probably my favorite intraday entry tactic for day 1, the anchored VWAP reclaim. The anchored VWAP is the anchored volume weighted average price. It's a method that a lot of institutions use to execute their orders, and basically throughout the day, it trends with the stock based on the price and volume action on that day. And it's often a significant level where stocks will find support and rally off of, and the best earnings gappers, or gappers in general, will reclaim it or even just trend above it the entire day and close well above it. That really shows you that institutions are being aggressive and just really looking to get shares at whatever cost they can. But this basically is a very key level intraday, and I'd really recommend studying a few recent gaps, what we'll show a few later in the session, and seeing how price reacts to this level when it pulls back to it, when it breaks through it, because it really can cause some nice entry points and also support levels later in the session. Here's an example with Unity Software. So again, the opening range breakout is here, but the anchored VWAP reclaim after we lost it is right here, a little bit earlier. You can manage risk right at this higher low, and you're off to the races. We trend above it nicely. And again, we had a nice move the next day as well. So this is kind of the ideal, where we set an opening range, we undercut the anchored VWAP and then reclaim it. And that's often the earliest buy point. It's kind of my preferred buy point here for these day 1 gappers. Here's a different kind of look at the setup. So this example here is where the stock kind of pulls in initially off the open. And this graphic is a little bit different, where we have an initial move higher and then pull back to the anchored VWAP, and often we'll pull back into it, retest it, and then push off of it. And that is often a really good buy point as well. We've got an example here with Coinbase. I think this is the recent one actually from yesterday. We had a really nice move higher, and then we pulled back into the anchored VWAP, the orange line here, and then this would be the entry point either at the anchored VWAP or after a little bit more confirmation as it breaks through this high. And your stop is just below the anchored VWAP, 1.5% risk here, and you can see how it trended above the anchored VWAP throughout the rest of the day. So this is ideal here, where it retests it once and just trends well above it the entire rest of the day. And the reason why this works well is because, again, institutions are trying to guarantee their customers, and a lot of algorithms are based on this, to accumulate and buy at the anchored VWAP price each day. So when we retest it, there's a lot of orders that come in and a lot of accumulation at those points. And if we trend above it, that's really showing that there's such intense desire for that stock that institutions aren't even waiting for a pullback to anchor VWAP. They're just trying to accumulate at any cost throughout that first day, because they really are aggressive in their accumulation. So this is a good example of a nice trend above that level. Here is a QBTS, a more volatile name. You can see how it holds the anchor VWAP early in the session. These would be opportunities to buy. And then also later on, we base and pull back and undercut the anchor VWAP and reclaim it. And this can often, again, be a good buy point if you missed the initial move higher. If it forms a constructive base, reclaims it, there's a nice low risk, higher low to manage your risk against. And here, the low of the bar is 2.2%, very tight. And your gain by the end of the day is 11%. So you have several risk multiples to deal with. And this can often be a really good buy point as well. Again, these are anchor VWAP reclaims early in the session. This is a little bit later in the session. And even here, we get a retest the anchor VWAP, and this would have been another good buy point. And as it rebounds off of it, place your stop right below that higher low. Here is another example here. We get several retests the anchor VWAP. We have a nice base back into it, and we get several reclaims here. and we have another intraday base breakout here. So this kind of shows a few different entry tactics all in one example of opening range breakouts, anchor VWAP reclaim in the first 5 minutes of the session, and then later on an intraday base breakout. And this is from a case study that I did for the Trade Lab. I don't remember what stock this actually was, but this is a good example of bringing it all together. The anchor VWAP reclaims early in the session, the opening range breakout, and then the intraday base against the anchored VWAP later on, setting up some different buy points where you had nice cushion into the end of the day. John asks, do you put your anchor from pre-market of the day or post-market when it gaps? I place it on the first bar of the day. That's really the one I care about. All right. Yeah, good question. I see a few questions about that, so hopefully that answered it. Basically, as soon as it opens, that's when I place the anchored VWAP. All right, so that is day one. And again, there's no real need to be involved on day one because the best gapper setups will lead to significant moves after day one. But this is probably the earliest point to jump on, and the top momentum traders, more aggressive traders probably want to get involved in day one. But know yourself, know your experience level, how you best like to trade. And if you aren't really, don't like being very active and very aggressive, or you work a day job, probably day two entry tactics and even day three and beyond is probably what you more want to be looking for. So let me get a sip of water here. All right. So day two entry tactics. The main one I want to talk about here is the high volume close. Again, this is the day one. This is a daily chart. This is the bar of day one. We have a really strong close. This could be on really big volume. And the high volume close entry tactic is when after this day one here, we consolidate a little bit, pull back, and then reclaim the high volume close level. And often you're placing your stop at the low of the day. This is really good because often when a stock pulls back in bases, it shakes below an intraday range that was formed into the close. And then we get a nice rally back through that range. And that leads to a lot of buying, a lot of accumulation, shorts getting squeezed if they're trying to fade, a move lower, and leads to a lot of, impetus for a big momentum move that gets us at a profit on day two here. So again, this is the high volume close, the close of the initial day one bar. And pretty much you want to place your stop just below the low of the day and buy through this HVC. And there are some variants of this where we could open higher than that high volume close, pull back into it, and then reclaim it. That would be another way to go about this. You place your stop to the low of the day and again, buy that reclaim, or even start buying as it pulls back into the HVC and then look to build out your position if it bounces and continues higher. So there's a few different variations, but this is the main one that we're looking for. Here's an example with Sezzle that just happened recently. We had a big day one here. We had a nice gap up on large volume. And let me zoom in here because in deep view here, we show how there's a nice 390% EPS surprise. That's pretty darn good if I'd say so myself. And this was a significant gap and decent action on day one. We did fade off highs here and set up a range in the end of the day, but we have a really textbook opportunity for a day two HVC buy. It opened a little bit lower and then burst through and was up, I think over 15, maybe even 20% on day two here. So you have a nice cushion to jump on. So again, you didn't even have to get involved on day one. In fact, you could have just scanned for gap ups and big moves on this day in post market and say, hey, I'm looking to trade day two on this bar here and be ready. So again, you don't have to trade day one to be successful at these, but they're just kind of different types of entry tactics. And here it is again on the daily chart, just to set the situation. And then here it is, this buy on an intraday time frame. So again, this was the close of the previous day. And then this is the HVC entry looking at a 5-minute chart. The risk to the low of the day was around 2%. That's excellent. That's about as great as you can hope for. And even if you have some slippage, because this really moved well off the open, you're managing risk pretty tightly. And immediately you're at a profit and it just trended nicely above everything into the rest of the session. You were quickly up over 10%, over 15%, can take a little bit off and then trail the rest. But this is a really good example of a day two buy point. And it just happened, a few days ago. And this is the anchored VWAP from the day one. I will leave the anchored VWAP from day one on my charts, because often, again, if we get an undercut and reclaim of that key level, that's still in the eyes of institutions a key level and can set up a good buy point. And this kind of coincides and has a nice confluence with the HVC. So another reason why this was a good entry here is the day one anchored VWAP and undercut and reclaim. All right. Here is the Tesla example, again showing the HVC entry on day 2. You had a nice move up with a strong close on the highest volume in 1 year. And then the next day we have a nice push through the HVC level, saying your stop at the low of the day. And by the end of the day, you have really nice volume, and your price here was never tested throughout this move if you decide to hold on instead of selling into strength right here. Here's another example with DocuSign. This again was back in 2019. This was before it made 300% move during the COVID times. But this was a nice move, gap up here on I think the highest volume ever. And then the next day it had a HVC entry, but then it did gap down the next day, test that level again, and set up another opportunity. So you might have gotten stopped out if you tried it on this day, but this entry worked as well. So again, real trading isn't always perfect. And I want to show an example where there's some, churn around that pivot. But again, just one trade like this, and it was quickly up over 20%, can make up for a lot of stop loss hits. All right. I see some questions about trading in pre-market. I don't do any trading in pre-market when it comes to these. I know, a lot of people who trade, who day trade will take trades in pre-market. It's not my style. I haven't studied that too much, but 100% if you find that works best for you. But I think that's kind of hoping that the stock is going to make a strong move on day one versus playing an entry tactic and playing a setup. So that's why we talk more about trading during market hours and seeing the setup and entry tactic unfold in front of our eyes. But if you can find an entry tactic that works in pre-market, the day of the gap, or in post-market the day before, after they report earnings, go for it, study it, see how it works for you. Maybe you start a pilot position on during post-market, and then you look to add on day one or add on day two. That's completely valid, but go in and study it and make sure you're managing risk, because post-market, again, it's a whole nother ball game in terms of how to set up orders, how to manage risk as well, because there's no stop losses. So you really do have to be careful. Crafty Giant says, do you set any high or low based on the pre-market? I don't. I'm more looking at the actual session and where those are as well. But I can't say that I've studied that, so that could work. So go ahead and study it yourself and see if that works better and sets important levels where it may be support if the stock pulls in. And good question from Maze here. How deep of a fundamental study do you do into these gap up plays? I basically look to see what is the catalyst of the gap, and is that going to significantly impact earnings or sales in the near future? And then after that, it's more just if that passes that kind of quick test, I look at the price and volume action to consider it. All right. So here's ELF, and this is an example of a stock respecting HVC. If you actually plot out the HVCs from each of the earnings gaps, it's amazing how it retested it and gave opportunities later on in the trend. So even if you missed it day 1, day 2, day 3 plus, it retested here and set up a nice oops reversal off that level. So this HVC is a key level, and if you plot it on your charts, you'll be amazed by how much it support later on in a trend. Here's ASTS showing the same thing. This was the day 1. Then it retests it, builds the range, and pops higher. And then here it set up another HVC breakout after a false move higher here. And this led again to, this was probably one of the best opportunities of the year. Much more of a high momentum play, but a really nice trend for the next few months, and gaining several 100% from this buy point here, and especially from this buy point here. Here is Root. Sometimes, again, we open above the HVC. And if you can manage risk enough to the low of the day, if we immediately burst higher from that open within the wick, within the space from the high to the close of the opening day, the high can also be a key resistance level, a variation where you're looking to buy through that level, manage risk at the low of the day there. And this would work really nicely on Root here, which just had a tremendous move here from this catalyst and gap up day here. All right. So those are day 2 entries. And I do want to emphasize as well that some of the entry tactics we talked about on day 1, the opening range breakout, the anchor VWAP reclaim from that day can be used on day 2. For instance, here, there was probably an opening range breakout where you could manage risk on a lower time frame here. But day 2 is more about taking a step back and looking at the HVC and maybe the high of that gap up day and using those as the key pivots. Now, looking at day 3 and beyond, we're going to talk about some different entry tactics, but really day 3 and beyond, you almost want to treat it more as a normal type of setup that you look for. You're looking for a tight area. You're looking for an oops reversal technique. A lot of those techniques we talked about in the main webinar apply to here. You just kind of want to work your way in after the stock has consolidated an initial momentum move. Because often, this isn't the case with Root because it just kept going. There's an initial move higher, day 1, day 2, day 3, and then we pull back and consolidate and, pull back into the HVC, pull back into the 10 EMA, and then set up another spot and rally higher from there. So day 3 plus entries are really looking for how to enter and manage risk after we've had that first pullback, form that first higher low, and then rally higher from that point and entering at that point where we're rallying higher. So here's a good example. We get initial momentum higher on day 1. We get a failed HVC breakout. That happens. That's trading. And we pull back and form a tight range. And then we re-break out through that HVC. This would be a valid buy point. You could also use this high as a buy point or even this high as a buy point as well if you're a little bit more aggressive. But this is just looking at the high volume close as a pivot. Here's another example. We've got a post gap range breakout. Sorry, I messed up this candle a little bit. Obviously, the close should be over here where we form a tight range. All the highs line up, and then this would be a buy point, setting your stop loss at the low of the day and entering as it pushes through this line intraday here. Here's an example with ALAB. I traded these setups. I had a position that I started on the earnings gap up day early in the session, and I had a little bit from earlier as well, and then it moved higher, pulled back, into the 10 EMA area. That's often where a higher low forms. We form a nice pivot through this high, and I added on this day right here as we undercut and reclaim that level. It pushed higher again, formed another range against the 10 EMA, and I added on this day as well early in the session as it pushed through and continued on with a nice trend. And this is probably one of my best trades of the past year. Reddit, very similarly, we had an initial momentum higher. So you can see how day 2 entries don't always work. And that's why it's good to have, day 3 plus entries in your tool belt. We get a pullback here, and I added on this day as well through this high. You can see how this is kind of a tight day here, and there's a clear line of resistance. Buying through here, get initial move up, and it sets back up on the 10 EMA again and continues on with a really nice trend above the moving averages. Here is TEM. This was the callus day again. We move higher. And then you have a very subtle range that forms here. You've got a pivot from this inside day. It fails to break out this day and squats, but then sets up the next day and goes. So again, sometimes with day 3 plus entries, you kind of have to work your way in to the stock. But if you identify a callus gapper, it's got high momentum, it's got a lot going for it, and you're just kind of trying to work yourself in while managing risk. And with range breakouts, you can do that. With oops reversals, you can do that. And we'll show a few examples. We'll show an example of HIMS later on, which is a very, very recent example that applies nicely. Here is Tesla early on when it was a really new stock. We have its first expected quarterly profit here, and it doesn't have some initial momentum. We actually just pull back right away to the 10 EMA, set up a nice tight range here, and then this is the entry point, the post gap range, and from here it set up a model book move up, I think 200% over the next few months. There's a good question from Vignesh here. Do you ever enter on day 1 and add on day 2 HVC? Yes. If so, do you manage as separate positions or just one? Yeah, 100% I do that. I would treat it as the same position. And, if it doesn't go on day 2, if it tries to push day 2 and squats and fails, I'm probably selling maybe even more of my position that I put on day 1. But if I'm adding here, I'm wanting the stock to have immediate momentum on that day 2 buy. Here is that example of Tesla again, just showing, again, you could have entered day 1, added day 2, added on these range breakout entries, and, built your position up that way. You could have a rule where you buy 5% of your position on day 1 and then look to add on day 2 or on a range breakout day 3 plus later on. But this is a good example of, different buy points that set up after a earnings gap. All right, so getting a little bit into sell rules of gappers. This is very trader dependent, how you like to trade. But I want to talk a little bit about how I do it. I use faster rules if I enter on positions on day 1 and 2. And to hold through to the next day, I want to have at least 2 to 3 R's. So if I'm risking 2% on my entry, I want to have about 6% profit by the end of the day to hold through to the next day, because high momentum moves can be great when they're going up, but they can reverse very hard, very fast the next day. So I want to make sure I protect myself. And then I'm selling about a quarter to 50% of my position, depending on the quality of the stock. Sezzle is more of a momentum name, so I'd be more likely to sell more of that into strength than if it's a Nvidia or Tesla that has a little bit more fundamental backing, a little bit more liquid, and more of an institutional quality name. I'd be more looking for a duration move for those type of names versus a momentum move in a Sezzle or a HIMS type name. Then for these type of plays, I like to trail the rest at the 10 EMA, a close below that if possible. And if I enter on day 3 plus on a range breakout or a whole new base that sets up, I'll use my more typical 21 EMA sell rules that I've talked about in previous webinars. Just high level routines for finding gappers. Again, post and pre-market, look for gap ups and analyze the catalysts. Judge if they're significant enough. Screen for significant gaps on day 1 after day 1. You can set up screens. We've got presets in DPU for gap ups over 5%. And then you want to set alerts at key levels, the HVC. And also, this is really important, even if you miss day 1, day 2, day 3, or the first setup day 3 plus, track recent gappers from that quarter and see if they set up pullbacks to 21 EMA or set up a whole new base, because those are the names that are under significant accumulation and likely will set up another good move later on. So it's a really good idea to be tracking recent gappers, especially if they're on HV1 or high volume ever. Keep them on some watch list that you review each week, each day, and look for base breakouts, range breakouts, other entry points for that stock, because often, like I said, after that initial move higher from that gap, they'll often set up a longer consolidation and set up another opportunity for another trade. This is important, so make sure you guys pay attention to this. When to trade gappers. Ideally, early in an uptrend, they work best because more people are doubting moves at that point. Also, when breakouts and other gaps around it are following through. During earnings season, this is more of a cyclical setup that occurs because, by nature, a lot of gaps occur on earnings reports, so they're going to happen more during earnings season. And you want to more trade earnings gappers when other earnings gappers are working. There's earnings seasons where every single one gaps up or acts well, and then there's earnings seasons where a lot of these get sold into, and you want to avoid them in that case and focus more on when they're working. Then, of course, the more game-changing the catalyst is, you want to trade it more. We're best when we're in an uptrend, QQQ of the 21 EMA. And this is really important. Like I said, don't force gap buys in bad markets. They are more likely to be exhaustive gaps and be sold into and used for distribution. Good question from someone, I don't quite know your name, but what role does short interest play in amplifying the effects of an earnings gap, particularly for small cap growth stocks? It's really big. So if you see short interest where it's going to take more than 3 days, 5 days to cover, that's going to add fuel to the fire on day 1 and day 2. And anybody who shorts on day 1 and then gets whipped out on day 2 is going to have to buy it back and cover. So if it's a heavily shorted stock, it can add fuel to the fire and make it a higher quality candidate for a nice momentum move on day 1 and day 2. So really good question there. Key reminders, gappers are cyclical, but they're a really powerful stock and setup that yields high momentum moves, and they can kickstart more duration moves, as we saw with DocuSign, ELF as well. The catalyst must be significant. I like to use quicker entry tactics, expect to be stopped out, and the best gappers, you'll see this if you study their intraday charts, trend all day above their anchored VWAPs after they may be initially tested early on in the session. So that's ideally what you're looking for, and that's a sign of significant accumulation. Is they just, after they test it, they just take off and just keep trending. So those are some key reminders here. Here are a few, like I said, gaps from the model book. Here we already showed Tesla. Here's FSLR, had a nice day 2 opportunity here, and then a range breakout opportunity here. Here we had a catalyst of an earnings surprise. So really nice move here from FSLR. And you had a base that set up later on. So even if you didn't trade this initial move, again, keep it on your radar. And you had a 21 EMA reclaim and nice move and trade from that area there. Here's Roku. This is one that Rye traded. You had a nice move on day one and just kept going higher, and then you had a range breakout, an opportunity for a move here, but really the opportunity was on day one and day two here. And the reason being is it gapped up on earnings with a strong sales beat and a 48% rise in accounts year over year. So again, you kind of want to think about what is the metric that institutions care about, and if they beat on that metric, that's what's going to lead to some momentum moves day one, day two, day three, and beyond. Here's Docu. This is the earnings gap that we showed here, and it set up many bases, and then right after this was the COVID correction, and then it set up another base, which I actually caught and had a nice trade in. But you know, the catalyst was due to a strong earnings report with a revenue beat, and it was on the highest volume ever here. So you really want to key in on gaps that act well on the highest volume ever. ASTS, again, this is a really key one to trade. Again, even if you missed all the early entry points here, it set up basically high tight flag range breakouts here along the way that, you know, led to 20, 30, 40, 100% moves. But this is the earliest kind of range breakout, and could enter on day one here as well if you'd like to. And the catalyst here was partnerships with AT&T and also Verizon here. All right. I see a question here about where these webinars will be stored. These webinars will be stored in the Trader's Handbook educational course, which you'll have lifetime access to. So it won't be stored on YouTube forever. We're just streaming it here, but you'll have lifetime access to this, and I'll send out the recording later on, again, either today or tomorrow. All right, I also want to show some failed gaps and some exhaustive gaps here as examples. This is DocuSign later on. This is a gap breakout on Zoom earnings. They were really trading hand in hand. And then, you know, we do have a nice day one move, but then we immediately fail and fall to the downside. And this is, if you see this in a gap that you're trading, it's probably a sign that the stock needs more time or is going to fail. And this ended up being pretty much the high for, I think, the next year. So don't get stuck in a stock and don't go through a 20% drawdown. You know, you want to use tight stops with this setup. You want immediate positive feedback to hold through. That's really, really key. Here is Enox. This is a popular name on Twitter. They had a gap up on FDA clearance, but you can see there was no move higher. Right off the open, it was sold into. This would almost be an earnings gap in reverse, where you could be shorting the stock instead of buying it. But again, no matter how game-changing the catalyst is, if it's not confirmed by price and volume action and doesn't show the entry tactics we talked about, you don't want to force things. You don't want to hold on and hope. You have to follow your rules and follow a clear setup and a clear entry tactic. So again, we can look to anticipate the market's reaction, but it's always price that has the say at the end of the day. And from this move, Enox declined 85% over the next few years. Here's Tesla, the end of the move in 2019. The gap up that initially started was back in this area here. But here we have an exhaustion gap, close off highs. This is completely different than an earnings gap that we're talking about. This is later in the move when it's already extended, and just based on price and volume action, it's an exhaustive move instead of the start of a potential new trend. So don't get sucked in and buying late in like an MSTR after it's already had a tremendous move. You want to see a fresh catalyst. That's what we're looking for here with this setup. Here's ELF, the top. We had the 6th gap in the trend. So again, we're looking for early gap ups. And you can see how it tried to form a consolidation, move higher, but then ultimately broke down, and you'd be stopped out on this bar if you did try this. But just in general, we're trying to focus on the 1st, 2nd, or 3rd gap latest in the move here. Here is, and that's it for the presentation. I wanted to show just some setups here. And I've got a few examples. We have HIMS. This was one I broke down in the Trade Lab pretty exhaustively. But we have the catalyst here is an NVO partnership where they could sell Wegovy on their platform. We have an initial pullback, and then this is the day to enter here through the high here. This would be a post-gap range breakout. And then even if you missed this move, it set up another opportunity on earnings where we had an initial gap down and then an oops reversal through this low. And that would be a way to work into a recent gapper that has a lot of momentum behind it in the markets. And we had a nice trade opportunity here from this point. Sezzle, we talked about this as well, but this is the day 2 buy opportunity. We can look at a 5-minute chart of this name. It's a little bit slow because I'm streaming as well, but this is that HVC entry here where you could have traded that. We have Dave. Let's go to a daily chart here. On Dave, also had a pullback at the beginning of the day into the anchored VWAP of the day one, and set up a buy point through the HVC as well as the day one high. Set up a nice swing trade opportunity if you didn't enter on day one. And even here on day one, an alternate entry tactic could have been as it pulled back into the base pivot and then rallied off of that, setting your stop at the low of the day. So you can be a little bit creative, especially if you're stage 3 or 4 with how you enter these names. Duolingo, again, another pivot would have been that base pivot, and it just immediately went and has been trending higher ever since. So sometimes they don't really set up an opportunity after day one. So if you're more aggressive, you want to be involved on day one. MGNI, another recent pop through 200 SMA. That would have been another alternate entry tactic and has progressed higher. Lyft as well, really nice action on day one. Let's see if we can go on a 5-minute time frame here and show that move. So this is a good example of an initial move higher and then undercut and reclaim of the anchored VWAP. And then look how it trends above the anchored VWAP the rest of the day. And even from this buy point, you're up about 8.9% into the end of the day, and your stop loss was very tight, only about 1%, less than 1.5%. Even if you've got some slippage on your entry point on this bar right here, that's when you'd be buying as it rallies off of that anchored VWAP. So if you buy right here, you've got a nice cushion into the end of the day to hold through and look for a multi-day move, which had so far. We also had an undercut and reclaim of the HVC. That would be another opportunity to get in, but since then it hasn't really progressed. So this is more consolidating, and you could almost draw a pivot really through this high here. And I'm doing this live here. I haven't really looked at this, but I'd be looking for a break through this pivot for some more initial momentum, or a pullback more into this area and a U-turn. And that would be another buy point if it sets up a range back in this area. But you don't want it to penetrate too much of this day one bar, because that would be a sign of weakness, right? The gapper setup is a setup where there's incredible momentum, and if it penetrates too deeply in here, that's showing that the institutions aren't really being aggressive, and we want aggression. We want to see that continuous buying, and we don't want it to give back too much if it does set up a range. So that's one thing to think about as well. CRWV, you had a gap up. There was some news on this day that I think Amazon and Microsoft were reinvesting more into their AI infrastructure, and that set up this gap here. This set up an entry point here. We had a gap up, reconfirmation here, and again, this is being a little bit creative with your entry points, but it set up different opportunities here, where the day of this gap up, we didn't really go anywhere, but the next day we pulled back into this range and rallied from it. So again, if you're stage 3, stage 4, there's creative ways where you can look to manage risk in a name that has recently gapped, and that's the whole name of the game. You're looking for a high momentum name that has gapped recently with a strong significant catalyst, and then you're trying to work your way into a trade where it still has a lot of potential, but your risk, your stop loss can be very, very tight. Coin, this is obviously the recent S&P 500 inclusion was the catalyst for this. We have another move up similar to Lyft that we just saw, pull back into the anchored VWAP, and your stop just below the low of this bar is about 1.5%, even if you buy all the way up here and you really want to be buying as it's pushing up higher. So in this area, and it trended above the anchored VWAP the rest of the day. So another good example of a catalyst here. TEM, I want to show, let's go to a daily time frame. More so this area right here that we already saw as an example. And this is a good example of working your way into a name that's showing high momentum with a range breakout or an oops reversal after that gap. So the gap kind of gets it on your radar, and even if you don't act on day 1, day 2, you want to look to find your way in to a name that has high potential later on while managing risk. Lastly, we've got ONON. This just happened yesterday. This would have been a pivot here. If we go to a 5-minute time frame, you can see if we add an anchored VWAP to this, you have an initial move higher and then pull back below the anchor VWAP. This would have been a buy point. You didn't know it was going to consolidate further. You buy, set your stop at this higher low. Just below that, it pulls back a little bit more, reclaims it again, set your stop at this higher low, and then you're off to the races and trend above the anchored VWAP. So again, after the initial entries early in the session, you want to see the stock just continue to grind higher and keep trending and be up 6, 7, 8, 9% ideally by the end of the day to give you enough cushion to hold through to the next day. And if we go back to a daily chart here, you can see it tried to rally through but failed. So if you bought on day 2 early in the session on the HVC or through the high, you'd probably want to take that off by the end of the day because you don't have a profit cushion. But if you bought day one, you still have some profit cushion to work with. So you could probably be holding on to your position and be looking for a reconfirmation, re-breakout, or a little bit more consolidation, a range to form, a pullback into this base pivot, and then look to add on a range breakout higher. So that's kind of what I want to show with these examples. And then just to show you my setup in DeepView here for the post-market movers, I would set this to an intraday time frame. There weren't really many good examples today, unfortunately, of strong moves, but basically I look for an intraday time frame. And then this is my setup. I've got post-market percent change and post-market volume. Those are the two key data points that I care about. And I'd sort, and let me clear my sorting. I sort first by post-market percent change. You can see this name, Foot Locker's gapping up here. But then you'd want to go look and investigate the catalyst, and Foot Locker isn't really a game-changing company, so it doesn't quite fit what we're looking for. But this could be a more short squeeze-based gap up here. And then post-market volume is huge. So if in general, if this wasn't Foot Locker and it was like an AI-related stock or something like that, it'd definitely be on my radar. And again, I'm looking for over 20% in terms of post-market volume versus the average at least, and the higher the better. So this is my quick setup. I can quickly, as stocks report, tab through and look at their post-market price action as they trade after the report comes through, and the conference as well. So this is a nice kind of setup in DeepView if you have it to get going, to quickly analyze post-market action and get ideas for potential day one entries for the next day. But that's pretty much it in terms of today's webinar. I'll answer a few questions here. So rumored by Wall Street Journal. Okay, so there's some news catalyst Foot Locker, but again, we want to judge the catalyst and see, is it going to be a catalyst that makes a move for the next month, 3 months or more? And an acquisition or whatever the rumor is, isn't necessarily the case for that. So we're more looking for game-changing catalysts, new products, earnings reports, all of that. All right, so that's pretty much it for today's session. I'll answer a few questions, but hopefully this is valuable. Let me know in the chat, what was the key concept or takeaway that you had for today, and hopefully this was helpful for you. So give me a thumbs up if you enjoyed, and yeah, let's see if you have any questions here. All right. I see a question about cushion into earnings. We're not talking about into earnings right now. This is more of a setup after earnings occurs. But just in general, if I don't have cushion into earnings, I'm not holding through because it can go anywhere. Is recent gaps also a DeepView setting? We'll be setting up a filter where you can find them easily. But we have a Christian Kwalamagi EP scan. That's a preset where you can find recent gaps and all that. Yeah, Jay, the Anchor VWAP's really, really powerful. Awesome. Anchor VWAP. Okay, I see Anchor VWAP was key here. Yeah, and just on breakouts, you want to see it trending above Anchored VWAP. So on any day where you want to see a significant move, you want to see it trend above that key level. Awesome, guys. And also, I just want to thank you guys again for having pre-ordered the book. Thank you guys so much for your support. I think you guys are awesome, first of all, for doing that. And, we really are in debt for you. Hopefully these added bonuses are helpful as well. Again, I've said this before, but the book is just part of the resource we're creating. By pre-ordering, you're also getting all the webinars that we recorded before, the 12 webinars, and then also these bonus webinars, really focusing in on the setups, entry tactics, all that hopefully go into even more in depth about how to actually apply the concepts in real life. So appreciate it. Min gap percentage, min volume, really good question. Min gap, probably about 5% is what I'd go for. And then min volume in post market, again, I prefer 20% or higher. And then on the day of the gap itself, I want to see volume at least, 1.5x the average. I don't want to see mediocre volume, really. Let's see. Perfect. Anchored VWAP is set at the beginning of the day. And then that anchored VWAP set from day one can also be relevant the next day or the day after. Excellent, guys. Perfect. All right. Yeah, the bonuses are awesome. Some people learn best from reading the book, and some people are going to get more out of the webinars. And we want to make the information available in both mediums. But also with the book, you've got a lot more model book examples of gaps to study. So that's a big pull of the book as well, is you've got all those model book stocks from the past 10 years to help train your eye in terms of what to look for. The bonus recordings will be part of the educational resource that we're setting up right now on TraderLion.com, but I'll send out the recording via email so you'll have it available right away. Do you use any other indicator apart from Anchor VWAP on intraday charts? Really good question. I do look at the standard pivots a little bit. S1, R1, all that. I'm still learning that and still studying that, but that's something I picked up from Oliver Kell. And those can be helpful in terms of identifying resistance levels. And if a gap up, pulls back into one of those key levels, I'll look to maybe place a trade off of that if there's nice confluence with a 10 EMA, 21 EMA. But for earnings gaps, probably you're going to be gapping way above those resistance levels. So it doesn't really apply too much. The Sunday bonus webinar recording was already sent out. I'll be sending out the link again if you missed it, but no problem. Yeah, the book is coming out very, very, very soon, guys. I can't wait for you guys to get it in the next few weeks. Yeah, I'll send out the recordings again. No problem. All right, guys. Well, thank you guys so much. I really appreciate it. I'll be sending out a quick form to get feedback on these bonuses. It'd be great to get some testimonials to share, how helpful this has been. Get your feedback as well, so we can, let other people know who haven't pre-ordered just yet if these are, value adds. But thank you guys so much for your time. Thanks for spending some time with me here on this Wednesday. Again, really hope this was valuable to you, and we'll see you this weekend for the post-analysis sessions, and then next week for the webinar just like this, but on pullback setup. So again, thank you so much for your time, and I'll see you guys in the next one. Cheers.